The following segment is sponsored by Daniel A. White and Associates.
The Rick Jensen Show on 101.7 FM, 1150 AM, WDEL, and streaming to your smart speaker and mobile device.
Ouch. No. I made a bad decision today. I actually decided to go online and see how the 401k is doing. Oh, no. Well, I have an ETF that's kind of heavy in tech, about 39% in tech. It's called IVV. It's iShares. And it's through BlackRock. It's a good fund, and I like it. But, yeah, it's down fairly significantly short term. It's like this is the kind of thing that I think about when I think about Dan White and Associates, and how glad I am that I'm able to be a client and able to share with you the kind of work they do, wherein they put together a plan. It's all balanced out. And if you want to do some things on your own and they work out, great. They don't, But the closer you get to retirement, obviously, the more concerned you are with, steady, Eddie, Freddie kind of smooth going planning and retirement income, because that's what they do. They are experts, and they're fantastic, specializing in retirement income. Dan Simon, great guy. He's on the phone right now. He's also one of these really good financial planners specializing in retirement income. He's in the Middletown office. You can always get him at 888-690-8820. Dan, thanks for being on, sir. How are you?
Rick, good afternoon. Thank you for having me on, and I'm doing just fine. How about yourself?
I'm glad you're had. So after the news at 1:30 every Wednesday, unless something else is going on, you guys always give us a great tip. Appreciate that. What do we have for today?
Yeah, so as you're well aware, a lot going on in the world, a lot going on in the news. I'm going to choose to stay in my lane today. And, this week, a lot going on in the markets. You got, the Magnificent Seven majority reporting earnings this week. And then yesterday, the Fed met. So I thought I'd talk about, the Fed's latest decision and what it means for your retirement. So, yesterday they announced that they're leaving interest rates unchanged. I think it was, kind of consensus. We thought that was going to happen. And, while it may not have grabbed headlines like an increase or a cut would have, I think it's just an important time to point out, the reminder that, the Fed's taking a cautious approach right now as it continues to balance inflation with economic growth. And, the decision, as I mentioned, it was widely expected. But, the fact that several policymakers actually favored raising rates shows that inflation remains a concern. I think your listeners, right, the consumer out there knows it's a concern, and that the path forward is still uncertain. So, what does it mean for you if you're retired or approaching retirement? Well, first thing I'll point out is that, listeners we shouldn't make decisions solely based off one Fed meeting. Markets often react emotionally on the short term. Markets are, up today, so good thing. But, successful retirement planning isn't built around, it is rather built around long-term goals, not headlines. So, what I will point out is that, higher interest rates today, they feel higher, kind of normal historically speaking. They continue to provide opportunities for conservative investors, and that's, retirees. They shift towards more conservative investments. So fixed income investments, CDs, other principal protected strategies, MYGAs, fixed annuities, they still offer attractive yields compared to what we've seen over the past decade. And the desire there, the appeal, I think, is the security, right? We know the markets are elevated. We know we've been on an unbelievable run in the markets, and it's not necessarily if, but, when's it going to turn in the other direction? So, I think it's just a friendly reminder that retirement isn't just about, earning the highest return. It's about creating dependable income, managing taxes, and protecting yourself from market volatility. So your investment strategy should really be based on, your personal goals and timeline, not trying to predict what the market's going to do or what the Fed's next move is. So,
okay. So
again, just
So my investments in Iranian nuclear development were not a good one?
I mean, did you sell them? I mean, you got no one to hold them and no one to fold them, right?
Yeah, did you sell them? Like years ago? Not just, hey, for those of you listening, just kidding. For those of you in Arden, that was just a joke. But I don't want to drag Dan into some of my silliness here, at least too much. Oh, too late. Anyway, no, you're right. It's all about a balanced approach. It's all about balance. It's all about that approach. And you sit down and you talk with Dan, and you might ask a question like I do, like, well, gosh, what do you think interest rates are going to be in like 10 years from now? And the answer is, who knows? By the way, you did talk about the historical interest rates. So as I recall, correct me if I'm wrong, historically, if you go back, I don't know, the 1960s or so, and you take a look at the average, median or average, whichever you focus on, of mortgage rates, I think about 8% has been pretty standard, pretty much the average, hasn't it? Or has it not?
Yeah, I would say somewhere between that 7 to 8% range.
Yeah.
For the 30-year mortgage, I mean, somewhere between 7.25% to 7.75%. So, historically, they're low. We're close to the average, but as you're well aware, the problem with averages are they're just averages. They don't happen all the time. So, we've seen periods of time like in the early 80s where, you had a 30-year mortgage upwards of 17, 18%.
God, yeah.
And, just 5 years ago, we had a record low at 2.65%. So, yes, averages, but doesn't mean they happen all the time. And it's a tough economy, tough time for interest rates, specifically with the new home buyer. You've got extremely elevated property values, and at the same time, we have an interest rate environment that some people are like, oh my gosh, right? We're paying through the roof for a loan, but historically speaking, it's right around average.
Yeah, right around there. Now, that also has a big effect on real estate. That's why one of the many reasons why there's a shortage is because you got older folks like me saying, wait a second, my interest rate, and I still have a little bit of a mortgage left, and mine's just under 3%. Why am I going to go get a mortgage even for, let's say, an extra $200,000 on top? Like I sell mine for 4, I buy one for 6, I got a mortgage for $200. Why am I going to do that at 7% when I got this one just under 3? There is that logic to saying, no, I'm just going to take this, pay it off, and I'm not going to move to another house or build an addition so that you have one floor of living. All these things are things that people are considering. And when it comes to financial planning, I've learned from you guys over the years that you sit down with somebody individually. Everybody has their own story. Everybody has their own goals. And what I just expressed to you could be part of that, and you take that into consideration, don't you?
Yeah, for sure. I mean, you look at it now, and it's like, somebody sells the home they raised the family in, and they want to downsize. Historically, that would mean you're taking equity, you're buying the home, and ideally either no mortgage payment or a reduction in the mortgage payment. And the environment that we're living in today, those scenarios, if we're not buying the home with cash with all the equity and the forever home that we had. It potentially puts you in a position where expenses are going up in retirement, meaning we're pulling more money from qualified retirement accounts. And, that's when the tax issue comes into the equation as well. So, yeah, as you mentioned, Rick, every situation is unique. And I think that's the importance and the value of having a personalized plan put in place.
Yeah, I mean, if you want to live near the grandkids, if you're that sort of person, as opposed to saying, to hell with the grandkids, I'm going to Arizona, I'm going to Florida, something like that, and you find out, gosh, you want to be by the grandkids, you want to downsize. It's you're spending more money because you got moving and easy. It's an easy $40,000 proposition to move into another house with any sort of repairs or upgrades or things like that. Might even be more. However, the solution, I guess, might be if you're living in the Wilmington area, just move down to Seaford. Then you'll find a deal. It's just wrong.
They are building everywhere. I was down there on Tuesday. They were building everywhere down there. That's for sure.
Seriously, I know. And by the way, it's not like there's big savings. Oh, no. You could easily drop $600,000, $800,000 down there in some of the communities they're building. It's nuts. But I really appreciate the fact, you want to talk about interest rates and where we are. Is there anything else?
That's all I had for the day. But yeah, I mean, it's an interesting environment we're living in today with, interest rates where they are, the market's where it's at essentially nearing all-time highs. And at the same time, the real estate values are higher than we've ever seen. So
I know.
Yeah, interesting times, that's for sure.
Wow. Thank you for the Chinese curse there, Dan Simon with Dan White and Associates, financial planners who specialize in retirement income. What's your Middletown number? I know the 888 number, but what's your Middletown number?
It's 302-449-0111.
Okay, 449-000. What is it?
0111. 302-449-0111.
It's another way I can tell that you're really good with numbers. Coming up on Sunday morning at early in the morning, around 7 o'clock or so, Dan White gives his On the Money right here on 101.7 FM, 11:50 a.m., and streaming live at WDEL.com. Dan Simon, thanks for being on. I appreciate it, sir. Good to know.
My pleasure, Rick. Take care. Have a great afternoon.
All right, you too.